Mayuresh Joshi, fund manager at Angel Broking, now joins in on the show. And Mayuresh, let's chat a little bit about the earnings, especially the ones that we've seen trickle in right now. And pretty much a surprise coming in from PNB this time around. You had the profits that might have been below estimates, but clearly the stock is cheering all of the positives in the asset quality.
Afternoon, Avan. Yes, clearly I think the asset quality has been a surprise specifically for PNB. But clearly I think whether this will sustain going forward and if we see any kind of hits being taken in the coming few quarters, in the next 2 quarters to be more specific, I think the trend consistency is very necessary. So in this case itself, I think the provisioning is much lesser on a quarter-on-quarter basis and the asset quality has been stable. In fact, better than what most expectations on the street were. So the stock is reacting, but I'll still wait for consistency to come through. And again, management commentary on how they foresee credit growth for the coming few quarters, and clearly how the asset quality, both in terms of the restructured pipeline and the fresh slippage figure.
What did you make of Maruti's numbers, Mayuresh? The asset quality or rather asset impairment has been a one-time hit, which is why their profits have been a little lower than street estimates. Again, it's a one-time loss, and do you think Maruti would continue to ride high as it had been in the run-up to the numbers and continue sitting in at a 52-week high?
Afternoon, Aisha. I think numbers were expected to be very strong for Maruti and they have delivered on all fronts. So 14% volume growth, the top line more or less in line with our estimates. The profit, if you adjust for the one-time impairment, a little bit higher than what we were expecting at 1228 odd crores. And again, the margins have held up on 2 counts. One, I think the yen depreciation clearly helping Maruti's margins because it plays out the lag effect. And clearly, I think there have been operating leverage benefits coming through because of a better product mix. Again, I think the kind of product suite that Maruti has coming forward, the X-Cross is expected to get launched, and the bookings for Celerio CS have been exceptionally strong. So yes, I think it's got a very decent product lineup coming up as well, and their existing products across ranges are doing better. So the realizations per vehicle has increased marginally. But in my opinion, at least from an FY16 perspective, from an earnings perspective at 220 rupees on an FY17 basis, I think it is priced close to perfection. So I think it's trading close to its fair valuations. So one really needs to understand the management commentary here as well on how they perceive volume growth to happen, whether it happens in excess of 10% as they had guided last time, how the monsoons pan out and how they're looking at the discretionary spending trends.
Mayuresh, what's the view coming in on the pharma space? Because while that was one dependable sector that everyone looked at to cushion the fall when there was volatility, things over there on a fundamental account at least seem to be getting a little bit weary.
So clearly, I think it's a case-to-case basis, Avan, and I think Lupin numbers have been extremely disappointing on all fronts. And again, the kind of acquisition that they've done specifically with the Gavis acquisition, I think on a market cap to sales of 9.2 times seems pretty expensive, though I think the future outlook might be positive. We are very close to our target price for Dr. Reddy's, and I think most of the pharma majors are incorporating a decent earnings growth. Having said that, I think Sun Pharma is something that we'll continue to like based on the fact that the integration issues though will linger on the balance sheet for the next 3 quarters. FY17 would appear far more better, and once the numbers start trickling in FY17, I think the stock will get re-rated. So in our opinion, I think at least from the top tier names, Sun Pharma based on valuations and again the earnings trajectory specifically with FY17.
I have to interrupt you there. Apologies for that, but we've got the PNB management live with us. Mr. KV Brahmaji Rao, ED at PNB, joins us on the show right now. Mr. Rao, what a fabulous quarter, and it's heartening to see that the asset quality has been stable this time. What were the key drivers?
Good afternoon. As you rightly told, we are very happy, but waiting for days to come to cheer up further. The strategy what we followed for recovery and containing the slippages has given fantastic results. We have strategized in such a way that strengthened the recovery department, 2 general managers looking after, and about that 3 EDs looking after all big accounts. So that's the reason we contained the slippages by this quarter. You have seen that 2,802 crores fresh slippages of course, 500, about 600 crores added to the existing NPAs. And the percentage gross NPA has come down from 6.55 to 6.47%, and net NPA has come down from 4.06 to 4.05. And because of that, NIM also increased from 2.79 to 2.90%. And one more thing I want to tell you regarding restructured accounts. Last quarter, our restructured book is increased by 8,000 crores. This quarter, only 675 crores. These consists of 22 accounts. These 22 accounts also applications received before 31st March, because the forbearance was there at that point of time, and no fresh applications received. It appears that only 675 crores restructuring happened this quarter, and that too received for previous quarter, as I told. And restructuring is picked up, and we are not finding any accounts or big accounts particularly in the pipeline for restructuring. And in the same manner, NPS also, I want to mention here one thing. Out of 2,802 crores slippages this quarter, only 4 accounts above 100 crores, and rest of the accounts are small accounts. As I have told you 2 quarters back, discussed with you, and I told very clearly, maybe after 2 quarters, we were visualizing at that point of time the recoveries would be better or more than slippages, and that happened this quarter. So against the slippages of 2,800 crores fresh and 500 crores existing accounts, 3,300, 3,400 crores, 3,700 crores reductions happened. So maybe, I don't say that pain is over, maybe continued for 1.5 quarters, and this phenomena, that reductions will be more than slippages, will be stabilized maybe from December quarter onwards.
Suffice to say that, Mr. Rao, you will maintain your asset quality going forward as well?
Yes, exactly what I mean. That slippages for next quarter also in the same lines. But further from December quarter onwards, that reductions will be much better than the present quarter.
That's great to hear.
Mr. Rao, I wanted to talk a little bit about your margins. What have been the Q1 margins that you've clocked in, and what were your key margin drivers?
See, what happened, there are 2 things. One is from advances side, and the other one is investment side. So, advances side, actually, because of the reduction in the base rate, our yield is, the interest income has come down or not up to the mark. Secondly, credit dispensation not happened very exponentially, though we have grown at 9.6% in credit at par the market. But despite all this stressed period and huge NPAs portfolio, and we increased our yield on advances by 5 bips from 9.51 to 9.56. As far as the investment is concerned, yes, last quarter we have done extremely well. This quarter, because yields are hardened, so because of that, we had to provide a depreciation of 375 crores compared to 380 crores. Write back happened last quarter. That means altogether 750 crores we had to, less compared to the last quarter. Because of that, our profit, you have seen that it has come down from 1,400 crores to 721 crores. That is the only one reason. And going forward, these investments will give good results, and when write back happens, we will be in very good position as far as the margins are concerned.
What's been the quantum of base rate cuts so far, Mr. Rao, and the cut in deposit rates?
Yeah, see, because expecting the cut in base rates, the reduction in deposit rates will have lag effect. We started reducing the deposit rates from last November onwards in different buckets, of course. For the 5 times we have reduced the deposit rates, and we are by and large, at par market. In certain buckets we are less than market. But despite that, our growth in deposits is 16.4%. It is good. And as far base rate cut is concerned, so far we have cut in base rate from 10.25 to 10%. That means 25 bips we are reduced.
So what has been, your tier 1 capital, and how will you be meeting your capital needs? What kind of capital infusion totally are you expecting from the government?
Yeah, though the acquiring capital is a challenge as on date, but we are well planned for that. You have seen our CRAR is 12.08% as of now, because we have postponed our QIP or FPO because of the market conditions. We have gone for 81 and Tier 2 bonds last year, totally about 3,500 crores. Because of our status or acceptance in the market, we got these instruments at a very, very reasonable pricing. 81 we got at 9.15%, and Tier 2 also got it to 9.25%. Going forward this year, we require about 9,500 to 10,000 crores capital. Of course, 870 crores government also infused last year. So going forward now, 9,500 to 10,000 crores requirement for this year, and up to 2019 as per Basel III we require 54,000 crores. Now every year, and our retained profit would be about 3,500 to 4,000 crores. Secondly, we are planning to go for 81 and Tier 2 bonds. And at the right time, when the market improves, we'll go for either FPO or QIP for the capital acquisition. And of course, we made a presentation to the Government of India regarding the requirement of the capital. So we'll see that how much we'll get from Government of India this year and going forward also. But with these instruments and this strategy, and we are very comfortable. Today also we are in a very comfortable position as far as the capital is concerned.
But you haven't heard from the government on an exact quantum of capital infusion. Is that what you're saying?
Yeah, this year they have to still they have to assess, and they have to plan the things.
How much are you hoping to get though?
Our requirement is, I told you 10,000 crores. We have put forth the proposal. But whatever we'll get from the government, as I explained to you, retained profit and going for other instruments, we can acquire the capital is a very comfortable position.
Okay, Mr. Rao, good chatting with you. Thank you so much for taking the time out and speaking with us today. Good to chat with you, and congratulations once again on a fabulous quarter. That's the other one, Dish TV, and kudos to that one, Avan. It's doubled its profit this time.
Oh my God, way surpassed what we were expecting, going in with high expectations, by the way, of a 40 plus crore rupee profit. And this time around, Dish TV has absolutely outdone itself, and clearly sticking to, by the way, the kind of guidance that the management has been doling out every time that they speak to us, and it's almost 100 crore rupee profit. I'm going to wait by and see if we have any more details. 511 crore rupees is what they've delivered in terms of top line growth. Now this is versus a comparable of about 638 crore rupees. So it's a little bit of a disappointment, given that we were expecting robust subscriber additions, the ARPU growth, all of that to contribute to a number of close to 774 crore rupees. And I think the street is just about digesting those numbers, flitting between the green and the red, because from a bottom line perspective, it's been a stellar quarter, while the sales growth has been a bit disappointing. Wait by for the margins as well, and of course that key number that the street will be monitoring will be ARPUs. Remember, we've been getting a slew of brokerage reports since the company put out its numbers last quarter, and I think each and every one of them have been going all out and upgrading the stock, revising their target price, saying that they're very confident that this is one of the best plays on account of the digitization story, and they're confident that they can maintain this kind of numbers, if not better them, going forward. So of course the management will be throwing more light on the numbers, but there has been a higher other income. Perhaps that's why you're seeing such an uptick on the profit figure this time around. 25.7 crores is what the other income has come in at, and this is versus about 11.6 crore rupees. But even if you adjust for that, it would still be a 70 odd crore rupee profit, which way surpasses the number that we were going down with at about 42 crore rupees. The stock price as we speak at about 118 for a Dish TV, so not bad going at all. It's been impressive pretty much on the main number that the street is clearly monitoring. And margins, of course, is something that we will be clearly monitoring. But the stock is sort of about finding its feet right now at 160.
So a mixed bag, you would say, right? Okay, that's the top line figure, which hasn't quite matched up to the street estimates. The PAT, yes, but it's got a one-time component as well, which is why perhaps you're seeing such a jump. The sales, though, have gone in lower by about 20% for Dish TV sales performance. The bottom line, of course, has surprised street, but yes, the other income component has also doubled this time around. We will get more details, but you're seeing a big cool off come in, 2.5% on Dish TV. Mayuresh, I'm going to come to you. I'm not sure how closely you track Dish TV. It's been a mixed bag, so to speak, for Dish. I'm still awaiting what the ARPU figure is like, but what is it that you're penciling in by way of growth from Dish TV?
So clearly, Aisha, I think the digitalization story is well known to the markets, and the expectation again is that there is a huge market to play out for. So the estimates vary anywhere between $9 billion to $11 billion odd dollars. The kind of growth that cable and DTH guys will have over analog is a well-known fact over the next few years, and that is the entire story that the street is banking on. Yeah, and that is the numbers that probably a lot of analysts are banking over the next few years. ARPU jumping probably from that 176, 178 rupees that we are currently witnessing, close to around 190, and even figures close to 200. So clearly, I think this theme is here to stay. But again, I think as I see the numbers prima facie, I think disappointing on the top line. And again, I think the content and programming costs, Dish TV managed to curtail that the last quarter round. And again, I think that is a key component because they contribute almost around 30% in terms of their overall costs. So whether they're able to curtail that going forward, and what probably happens in terms of even their ad spends. And again, I think the other income component has been quite substantial this time around. So I think it's been a mixed bag. So in all probability, I think the stock was expecting a little bit too much. In fact, people were expecting too much from that stock, and the stock already has moved reasonably enough. So I think one really needs to understand how the entire theme is getting played out, and again, I think how the numbers will pan out in terms of subscription additions, how the subscription growth has been, and how the management perceives that growth to be over the next few quarters.
Do you think that, Mayuresh, that's perhaps the reason as to why the stock is reacting so adversely to a profit number that strong? Is because perhaps the stock has seen enough of an uptick already in, and a sort of and the street, as you said, was perhaps expecting a bit much from the company. And, we do have more details, Mayuresh, by the way, which I'd just like to share with you. In fact, we have some more details when it comes to the digitization effect. They said they've garnered the highest ever subscriber addition in the last 3 years, which has come in 27% higher than the incremental market share. Subscriber revenues up 20% at 682 crore rupees, and EBITDA is at 236 crores, up about 51%.
So clearly, yes, to a large extent, Avan, I think this is what the street is expecting. And again, in terms of pure subscription additions on a net basis, you're expecting exponential growth going forward. And the entire basis is that a lot of the analog viewers will shift either to DTH or cable. Now, the advantage probably with the DTH guys is that they can bill, and the gross billing happens much faster than what the cable guys can do. So I think it has factored in a lot of the positives, in my opinion, in the stock price. So one really needs to understand from the management how they are perceiving the general environment to pan out. And again, I think you will see some amount of issues, because I think you will see content costs going up over the next few quarters. And clearly, I think the transponder element is something which would also have played out. But again, I think as you grow further into and make more inroads into other cities as well, I think that capex plans also, I think, pan out. So again, I think cash flows will get affected going forward. So I think I'll just be wanting to hear what the management has to say on all these aspects.
Mayuresh, thanks very much for joining in and giving us a detailed insight into what you made of the earnings so far, as well as the overall monitorables. So for Dish TV, it's been a pretty stellar quarter, at least when it comes to the key figure in terms of profits. But we'll take that quick break right here on the show. Be back with more.